presentation, but we'll give it a start. Okay, so hi everyone. So we have Ismael Reyes here today. This is Finance Meets Real Estate. We meet here normally on Tuesdays. Today's a Wednesday. I was traveling myself, so we have like great guests here every week. A lot of the great questions asked by some of you guys. It also gets posted on YouTube. So it's a YouTube channel as well. Make sure to check it out, Finance Meets Real Estate on YouTube. And so today is Ismael Reyes. So he's going to talk about do what you love, invest where it makes sense. So that's the topic. So he has a portfolio of over 100 million in multifamily assets. And so he's going to talk about how others can possibly create generational wealth. So he has been investing in residential real estate since 2005 and focused on multifamily since 2016. So his companies are like the Admirable Group and MI Real Estate. And he has led investment firms in the acquisition of 14 multifamily properties, totaling over 900 units and valued over $100 million. Okay, so he is also host of the Greater Central Florida Multifamily Investors Meetup. It's a monthly virtual meetup. He's a best-selling author of BWAF, the bottom line upfront about passive investing in multifamily properties. He used to be in the U.S. Army as well, and he received an MBA from Columbia Southern University in 2010. He speaks Spanish. He lives in Central Florida himself with his wife and business partner. He's got a great story, great value, I'm sure, to share with us here today. So I'm gonna pass it on to Ray. And if you guys have any questions, feel free to speak up. And we're gonna have a short Q&A at the end as well. Thanks.
Yeah, thanks, Stefan. This is just great. Thanks for having me on your show. And I'm excited. I think the way I think this would work best is if I essentially just give pieces of where I want us to kind of focus, and then have people ask questions as we go there. And then really, instead of some sort of formal briefing, just kind of go where the crowd is taking us as far as questions or where you want. So what I can do is I can start by just talking a little bit about me and my background. So I was born in Puerto Rico. I was raised in Milwaukee, Wisconsin. We moved there because, frankly, it was the cheapest ticket, and there was good jobs in the late 70s in Milwaukee. Essentially, a lot of industrial work there. So my mother was a sewing machine operator. My father worked in a tannery. It's fine. It was blue collar work, but it taught me the value of working. And one of the things that I remember growing up is the excitement that I had when we went from renting to owning a house. So we finally, we were able to buy a house, do a lot of work and sacrifice, and it kind of stuck with me. And so as a kid, I remember Monopoly was my favorite game. It's something about, going through that board. You start off and you start off renting, simple units, and then you go into buildings, and then you essentially go into a hotel, right? And the concept, although it sounds primitive, it's exactly the kind of stuff that our kids should be learning about, and really having that ingrained into them, that's kind of the way ahead. I mean, it seems like a lot of society wants to just drive us towards working for others, and so it was kind of good to have that, as a pillar for me going forward. We were not rich, and so when it got to the point where I needed to go to college, I enlisted in the National Guard, and it was functionally essentially so that I can have money for college. But it ended up being a lifelong passion for me. I finished my degree, my 4-year degree, and instead of looking for work elsewhere, I essentially went right back on active duty as an officer in the Army, and spent the next 20, I guess it would be, if I don't count college, about 23 years. So total 28 years of service, about 23 years, after I graduated from college, and it was something that I love to do. The duty of it stuck with me, and I love some of the aspects that really translate well going forward. Is the aspect of teamwork, the aspect of, mission accomplishment that are key tenets of the military. And so that kind of stuck with me. And then as far as how I got started in this business, the military does a good job of giving you options. They move you around. You don't know when you're going to be essentially deploying, but when they move you, you kind of stay for about 3 years, and they allow you to decide where you want to live. You want to live on base? Do you want to rent off base, or do you want to buy off base? And essentially they provide you funding. It's basically allowance for housing allowance for living off base. Now, whether you buy or rent, they could care less. That's on the individual person. But, to me, it never made sense to rent, again, because when I look at my upbringing, it just didn't make sense to be a renter. And so after I did that several times, I found myself with a decent little portfolio of single family homes. These weren't the kind of homes that you buy with the intent of these being cash cows or rentals. These were properties that my family and I wanted to move in. So that doesn't always translate best for immediate returns, but over the life of these properties, they start appreciating just like everything else. So, and there are multiple ways to make money in real estate, and that's kind of the beauty of it. That's kind of it. I started there, and then once I got towards the tail end of my career, I really wanted, and I decided that I wanted to go full time into real estate. Then I needed to figure out what the best way forward was, and single family didn't seem like it was going to scale. And let's face it, I wasn't getting any younger. I was already in my mid to late 40s when I started thinking about this, and I needed a way to scale quickly in this business. And that's when multifamily started taking more and more of my attention. And then finally I figured out how to do it. I think the mentality is you gotta work these things as a team. I think if you're willing to work with others and you can create, these boundaries and these companies and these entities that allow you, structure you to be able to do that, I think it's a great way to move forward.
Mm-hmm. And so that was 2016, right? When you decided to move to multifamily and kind of for its scalability and so forth. So what was your experience in terms of like the transition, from SFR, like where, okay, now you need to be a capital raiser, you need to perhaps go more online and be more visible and, doing that whole business, kind of doing real estate as a business, actually. Like what was your experience? What are some of the lessons that you learned at the time, and like some of the things that worked for you?
Yeah, I think the biggest lesson that I when I talk to people and they're looking at making a jump from essentially a W-2 job into doing, potentially being an active investor, is you really have to do the math. Not on the acquisition. That's going to come, and you have to do that. You have to do the math on how much money you need to live, because if you don't have enough money to live, for yourself, it's probably not that big of a deal if you as an individual make sacrifices. But when you have a family, when you have children, there are other considerations that you have to have in place in the back of your mind, and that should drive you to a number that says, okay, if I can make this much money within, between my savings and, money that I have coming in from maybe some rentals on a single family, whatever the case is, this is going to be the trigger point to be able to make that transition to full-time investment. And so I think that's the first consideration for me. I had a retirement, so I knew, okay, so if everything else went bad, I had a military retirement that I can work with. It wasn't gonna essentially make me rich, but it was enough to pay the bills, and it was enough to allow me to focus on multifamily and growing the business. I think the hardest part outside of that, from an operational standpoint, for me is in my military, job. I spent a lot of time working under, secure compartmented information facilities, or SCIFs, and I'm sure a lot of people have become more familiar with the term SCIF recently than in the past. But what that meant to me from an operational standpoint is I couldn't be on the phone talking to people about, hey, investing in this deal or negotiating with a seller or a broker. It became very hard to try to do both. So I knew that if I needed to move forward in this business, I had to kind of hang up my military gloves completely to do that. Not everyone has to do that. There, you can essentially, you can transition from a W-2 to a full-time investing if you have the right kind of job and the right kind of environment, if you have some flexibility about how you can manage your day.
Mm-hmm. Got it. And so when you started in multifamily, like what was your experience? Did you start smaller first, or did you jump right to like the bigger properties? You know, I know people have different experiences. Some people start with like, you know, $20 million properties. Some people start with like $1-2 million properties. And so what was your experience with that, and like your approach, and kind of like what was your personal inspiration and way to do it?
Yeah, that's a good question. So one of the first things I did, it wasn't a big property, but what I had to do, I didn't pick the property. Essentially, the team picked me to work with them on that acquisition. And so I'll explain that. So when I got to the point where I decided that I wanted to get into multifamily, I started networking. I started to go into events, multifamily events, where you're meeting a lot of operators there. These aren't people that are necessarily, you know, wanting to be passive investors, but they're in the business. And so I started networking and saying, hey, this is who I am. This is my background. This is what I'm trying to get out of my career moving forward. And oh, by the way, here's what I can offer you, because you can talk about I all day long, but unless you put it in the framework of what you can offer a potential team, it's not going to really resonate with them. So what I said is, I have some capital. Essentially what I did is I sold off one of my single family properties, and that's what I had as kind of my money to get into a deal. And I was willing to put it in risk capital, and I did. And so they called me. I essentially had some meetings, and I remember, I think maybe 6 months later, you know, this group called me and said, hey, I remember you wanted to get into a deal. You still want to do that? Great. And so it was a 59 unit property in Tampa, and we bought it before Tampa got overheated. And I think we were at 62 a door, which was something around there, you know, low 60s, which is crazy, because right now, most of the time you're at 110, 115 a door, and it had gotten as high as 120 a door. And we're talking C-class, right? We're talking C-class, you know, kind of, you know, nothing fancy, just blue collar apartments. So that was kind of it. And so it wasn't a function of size. It was more about the opportunity at that point in a market that I liked, because I did do my research and I knew where I wanted to focus my investing. So it was important that when I talked to people, I said, these are the places that I'm looking, in addition to here's how I can help your team, so that we had a decent fit. So I think that was the genesis of starting.
Mm-hmm. And so what was your offer to that kind of that sponsor team that, you know, kind of invited you or like took you on that first deal? Like, were you doing the capital raising, or were you doing like the asset management, or like what kind of, or underwriting help and so forth? What was
yeah, it's a good question. And what I told them was, listen, I want to be able to focus on raising capital. That's something that I always wanted to do. However, in the military, we were not really allowed. It was frowned upon to have social media and to tell people where you were, because there was a security risk involved with that. So even though I wanted to do that, I knew it was going to be very difficult. So I told them, I said, listen, this is what I want to do, but I don't want to tell you that I'm going to be able to raise a bunch of money, because I've never done it before. But what I can do is I can put in up to 100,000 of my own funds to get into this deal for the right opportunity. And I was willing to put some of it in risk capital and move forward with the intent of trying to raise capital as well. But that's not the way I pitched it. So essentially I put it in a way where it's like, okay, if I raise $0, I'm still going to put in my money to contribute to this deal, and it's going to be valuable to them, because I think there's a risk, right? Nobody wants to know. One of the things that makes it difficult to just be a capital raiser, and that's not what we are. We're operators, and some of us focus on raising capital. Frankly, everybody on my team raises capital. No matter what their main focus is, they have to raise. That's part of the job. But you got to be careful with saying, "Hey, I'm a capital raiser," because that's not within essentially the parameters that the SEC has for these deals. Essentially, you can raise capital, but essentially your team has to guarantee you a percentage, regardless of how much you raise. And it puts that team in risk if they're doing that and you really are not able to raise anything. So the way to get around that is you buy into the deal with your own funds, So that's how you buy into the deal. That's how you get your percentage of the GP. And then if you raise money, fantastic. Then there you can figure out and negotiate maybe to get a little bit more for your effort to do that. But it can't be because I've never done this before, but I'm going to raise $1 million. That's crazy. And somebody that's never done it before tells you they can raise $1 million. I'd hold on to my wallet and go the other way real fast.
Okay, makes sense. And so like having done like multiple deals, like over 14 deals across 900 plus units. So what's been your experience in terms of structuring the deals where I've heard in the industry where sometimes deals will get done on like sort of operating agreements, with like managing, non-managing members and so forth in comparison to doing like the whole PPM. Like, what has been your experience with that? Like, is it always necessary to do a PPM? Like to some of our audience, like who are aspiring syndicators, like what is your sense of when is it appropriate to do a full PPM and when that may be kind of an overkill?
Yeah, I mean, I think there's you got to run the numbers. I would say that if you're talking a loan amount of probably 2 million plus, I think you get into the realm of a small syndication. Now it depends on where, right? Because essentially the smaller the property, you're not going to be able to have dedicated payroll associated with it. So you'll have to do third-party management, property management, and essentially have everything be off-site. But you can still do that. I think for me personally, I think that's about the right number. Anything less, and it's probably easier to get 5 or 6 folks to come together as a joint venture and not syndicate the property, simply acquire it. So it's probably there. I mean, it just depends, but you want to do the assessment, and there may be somebody that has sitting on 1031 money. They got to move, and they may need to move a sizable chunk, and you may be able to find a smaller deal that they can get into and really solve your problem without having to go through the process of doing a private placement memorandum and going through a syndication process.
Mm-hmm. But in those smaller notional sites, would you say even if some of those joint venture partners are non-managing partners, could that be a potentially, and I know it's an attorney question, but could that be potentially acceptable in that case for sort of managing partner / non-managing partner joint venture, or should one name, even as long as it's any kind of non-managing side involved, even if it's a 1 million loan only to do the full PPM? I mean, I'm curious, like as a more experienced kind of syndication person, what's your take on that? Like for some of our like starting syndicators out there.
Yeah, I think the going in premise for a syndication is that everyone on that general partnership team is going to have an active role in the deal. Now, what does that mean, right? So you may have some people that their only role in the deal is providing risk capital. Essentially, I'm putting my money at risk, and if this property doesn't close, you get to keep, I don't get my money back. But for that, you're going to charge a fee, a percentage of that deal that then becomes a part of your general partnership split. And then what you want to do, essentially just be part of the meetings, but your role in that deal was fulfilled actively. You essentially had your money in play, and essentially when the deal closes, you are part of that deal from that perspective. If you don't have risk capital in the deal, then I think you have to look at it more of a long ball strategy where, figure out what's going to get you into the deal. If you found the deal, you're in the deal because you found the deal, right? You've already done due diligence. Maybe you've done some initial stuff that you're doing. You're probably going to have your own risk at play because you have to provide earnest money. So if you find a deal, I think it's a no brainer because you're going to be involved until you exit, because you've got that skin in the game. But I think everyone else, you have to make sure that those folks have an active role. So what you don't want is, a general partnership team that has 10 entities in it. Because, unless it's a huge asset, there's not 10 active people worth of work in that deal. You'd be hard pressed to really make that argument if somebody were to kind of look into this a little bit deeper because somebody complains to the SEC or something to that nature. I think we may see some of that as going forward on some of these deals that people were essentially stretched out a little bit too much, and now all of a sudden with this potential downturn, if you're caught in a bridge, there may be some investors that are not happy with their return, right? It could happen. So they're gonna, if somebody complains, the SEC is gonna start sniffing around and asking questions about how was your deal structured, and who are all these entities, and what are they doing on this deal? So you got to make sure that you have a structure in place that really defines what people do, and then you really got to hold people's feet to the fire. Now you can't force them to come to meetings. So if somebody decides that towards the because what happens, everybody starts great and everybody's participating, and all of a sudden you get some folks that fizzle out. Well, that can happen. So you just have to make sure that you keep them informed, you keep inviting them to the meetings, and then never work with them again, because essentially you can probably discuss this and say, hey, this person was supposed to be involved the whole time. They decided, they opted out of it, if it came to that. But you don't want to be associated with that kind of that entity or that business where they make false promises. But essentially, if you go into this with a plan in place and you stick to that plan about what people are going to do in the deal, then that's fair, and that makes it an active participation.
Mm-hmm. Okay, yeah, that makes a lot of sense. And so for you, like, what has been your approach capital raising in terms of what has been most beneficial to you? Like, to some people it's their webinar, podcast, could be website. Like some people have their websites in better kind of search engine optimization state, and so forth. So like, what has worked the best for you personally? Because you mentioned like yourself as a person playing a capital raising role on most of those deals or all of those deals.
Yeah, I think when you talk about essentially how you build your ability, your brand to be able to bring investors to deals, I think it's a personal branding thing. But I can tell you that what was very useful for me is I went through a process of getting out there on social media, and I very much focused about providing value to people. So if you go on, people that go on my website, and I will talk a little bit about that later, but you're going to see blogs on there that go back 3-4 years on information that I was providing about, essentially investing in multifamily properties. So that's one aspect, right? So you're building your subject matter expertise by providing content to people, and they're seeing you do that, and they're seeing not just that you're able to do it over 3-4 months, but there's sustainability there, because they're trusting you that you're providing them a deal that could take up to 5 years or longer to get their money back. So they need to believe and trust in you. So that was a little bit hard for me, because essentially I had a reputation as a military officer, and I, in my work in the military officer, it spoke for itself. I'd already gone through a process. In fact, I got out before I was even to the point where I was going for what we call it the board, which is where you get selected to go to the next rank. And the next board that I had was colonel. I mean, essentially I got out as a lieutenant colonel from the Army. And so in the military world, I already had subject matter expertise. But it was hard to translate that subject matter expertise in the military to, by the way, give me your money. I'm going to show you how to do this investment, and here's why this is just such a great deal. And it's tough to make that transition. So what I felt that was most useful for me at that point is I started writing, and then I took the blog over time that I'd done, and I essentially had enough material that I was able to turn that into a book. So I wrote a book. And tells a little bit about me, but it mostly talks about multifamily properties and it talks about essentially how to go from point A to point B. And that's essentially kind of that first step. But I would say in general, you have to build a pretty broad base. And what I mean that by base, your platform for your personal brand has to be fairly broad. I mean, you have a very tiny base, it can flip over, right? So you want to create multiple touch points where people can see you, hear from you, and essentially start trusting you without even having a conversation with you, because they're seeing what you're saying. They're looking at you. They're looking at your material. And in my case, a lot of times, being in the military does help me, because You know, I was one of the things about MI. People ask me, "What's MI stand for?" People think it's Michigan. Well, it's my wife's name and my name, but it also stands for what my career was in the military. I was a military intelligence officer, and so that means that I had a top secret clearance. That means that I had already a certain level of scrutiny that was already on my person. And, you know, and it does provide some people some level of comfort there. But if you don't have that, figure out how you can get people to trust you. Some people just, they look trustworthy. I don't know. It's hard to explain, right? But you still have to have a base. And the wider your base, the better it is for people to get comfortable with you and want to have that follow-on conversation about investing. That's first. And then second thing is, once you have your first deal and you have a couple of investors and you've gone full cycle, then all of a sudden those investors that got that 2x return, first of all, they're investing in your next deal. And second of all, they're talking to others about you and about how you made them money. And that, you know, and that also builds additional, you're actually, you know, that's the best kind of trust, because it's not something that you're telling people about yourself. It's somebody else telling them about me. And so that also automatically is very useful.
Mm-hmm. Yeah, and you make some great points there. And yes, some people do appear trustworthy and some people are more competent than others. And, you know, it does make a big difference in capital raising, no question about that. And so what about deal flow? Like, what's been your experience? I mean, you've invested in like over 14 multifamily properties. And that's a lot of agent relationships. That's a lot of deal prospecting, underwriting, reviews, and so forth. What's been your way to build a consistent system to be able to scale your business and continue having deal for you know, like year after year, all the time?
Yeah, great questions. Great questions. I'll tell you right now up front that I don't worry so much about having a bunch of properties that I'm going after. And the reason for that is I'm building my business incrementally. I want to have a solid base, not just with the investor base, but in the business. Because what happens is you get a lot of younger folks talking about how many doors they have. I got, you know, I'm going to do 1,000 doors this year. But that means nothing if the minute they buy that asset as part of a team, they're moving on to the next property and they're not paying attention to the operations in that current property. And you get too many people thinking like that. They're always looking at that next deal. Think about that. You know, a general contractor that you hire to work on a property, and the minute you hire them, you know, there's like 6 people on the team. They get the next job, and he pulls 4 people off your job to go work the next deal, and you're kind of like, hey, man, what's going on here? Well, I make sure that we don't get into that position. So I'd rather not do a deal if I don't have the structure in place, the operations in place, and more importantly, a boots on the ground person that I trust at that, you know, at that location where we're doing that asset. Now, having said all that, so that based on the incremental piece, essentially, I have members of the team that do specific roles. One of the things that I don't like doing very much, and I'll be honest about it, I don't like talking to brokers. It's not that I don't like brokers. It's not that I'm afraid of talking to brokers. It's just that a lot of times the brokers are giving you information that is not entirely, you know, the most conservative of data. And sometimes they give you numbers and you know they're going over the top and you're like, come on, man, I can't. So there's like a dance that you have to do with brokers. You have to build that trust with them. And essentially, I have people on my team that do that very well. So when it comes to engaging with brokers and looking for deals, there are people that's their main effort. You know, I focus more on make sure that we create the structures and make sure that we have the people in place to to deliver what we promise, not just to investors, but also to the broker who's wants to make sure that whoever they're doing business with is able to close on these deals. They don't want tire kickers. They want people that can execute.
Right. And so what about, I know you mentioned like investing like some of the high growth markets, and you've picked some, you know, amazing markets that have done really well, like Tampa, and it's $62K per door, right? And so forth. And so, so what's been your approach there? I know like people speak to like, you know, like picking based on job growth and different factors, or what kind of employer diversification, or what kind of new employers are coming into that market. Like, what are some things you particularly like in like picking upcoming areas to invest in?
Yeah, no, good question. I go through an initial process before we even start looking at individual properties, and it's really to select those locations. And what I use as a kind of a formal upfront before I start digging in deep into any particular deal is I call it's a big three plus or minus R, and I'll explain it. So the big three is I want to see a significant amount of population growth going into an area. There has to be enough population growth to sustain essentially what you're trying to do, which is potentially raise rents, bring some people in. If it's a new development, you got to consider what other properties are already in development as part of your numbers. But essentially, if your population is dwindling or there's people leaving, probably not a good place to look at, because it just makes your job that much harder when you have less population going in, because your demand is lower. So that's kind of the first one. Then I have two that are very related. One is GDP. I want to see a pretty stable GDP or a GDP number that's going up. I don't want to see GDP numbers going down, especially over time, because that tells me there's something going on economically at that macro level of that metro or larger area that you're looking at.
Meaning,
and then the last
metro area GDP. That's
correct. I want to be able to, to take a look at the GDP of, ideally, you want to go a little bit deeper, but I think where you go deeper is when you get unemployment numbers, we're looking at unemployment numbers. We want the same thing. We want to be looking at a trend, a positive trend when it comes to unemployment. Those two are very similar. GDP and unemployment, they kind of work together, but they don't always align temporally. So that means that you got to monitor both to see what may be going on. Maybe one of them is kind of tailing down and going to be driving back up. So you got to look at both of those stats at the macro level. So when we go into the micro, that's when that's when it becomes important, because the first thing I want to look at is political risk. So that's your minus. So your big three, and then your political risk is your macro risk, if you will, which is what's happening in that state, in that county, from a political risk standpoint, being for us, most importantly, is there discussions about rent control? What does the business community feel about what's happening in that location? So you want to make sure that you're in places where, you're not necessarily, wanting to be in a place where, people are getting kicked in the streets after 30 days. That's not it, because a lot of people go, well, you don't want to be so pro-tenant friendly that becomes the case. I don't want to be associated with those kind of properties that are really abusive, but I don't want to be associated with a property where somebody can sit on it for 10 months and not pay rent. I have a fiduciary responsibility to investors, at least, to say, here's my projections of what's going to happen, and I have to do the best of my ability to make sure that we're investing in those places that'll give those returns, because frankly, I won't be in business very long. I won't make any money, and neither were they. So, this is a win-win kind of business. So you got to look at that. That becomes important. And then at the risk at the micro level is, now you really got to drill down, because you got to look at crime, these crime statistics. You can't do crime statistics over a big area. You got to zoom in to the neighborhood level to see what's happening in crime. And you definitely want to see a trend in crime that is improving. And you don't want to see I don't want to invest in a place where crime is growing, because that's a bad sign. So that's kind of how I pick locations. There's more to it, but I mean, it doesn't make sense to even go in and start digging into underwriting numbers unless those things align.
And what about the size of the market relative to the property? So let's say if you've got a 200 unit property, what's a threshold for the population of that metro area or population of that city and so forth, that you feel what's a ratio that's appropriate of property unit size compared to population that is kind of a good rule of thumb?
Yeah, I can say I don't want to invest in places where the population is less than 200,000. So that's kind of my lowest number, and I don't mean a city, because sometimes you're in places where, the city may only be 100,000, but when you kind of look at the entire area that spreads on and you have the suburban areas associated with it, you have a lot more population there, right? So I'd say 200,000. As far as size goes, as I mentioned, I think you really want to be over $2 million for syndication, but the sweet spot for us has been so far 80, maybe a little bit more than 80, because that allows you to have at least dedicated payroll and it reduces your costs. Third-party management can be expensive, but if you're able to bring in third-party management with payroll, then you control the cost of your leasing and your maintenance in the property. And it allows you to, at least if you have at least 90, you can probably do one of each on site. And then your property manager is probably getting 3%, 3.5%, right? So you can manage those a lot better. If those numbers are lower, your property management is going to be probably a little bit more expensive, and they're not going to be on site. They're going to be off site, which makes it a little bit harder to keep that property up to the standards that you would like. You want someone to go into a property and have somebody meet them at an office and kind of, show them a tour on a property, et cetera. If it's just a number and you're having to go somewhere else to rent, it's a little bit harder to operate at that lower scale.
Exactly. Yeah, that makes a lot of sense. And so do you want to open up for some Q&A, like from the audience?
Yeah, absolutely.
Yeah. So do you guys have any questions? I went over a few questions myself. I want to make sure it kind of like serves the rest as well. I see Scott over there. How are you doing, Scott? What's up? Do you want to ask something perhaps?
Yeah, I will say I had to step away from a phone call, so I'll be embarrassed if I ask a question that's already been answered. But first of all, Ismael, thank you for your service and thank you for being here today. I've really enjoyed what I have been here for. And I think, for someone like myself and probably like the rest on this call is that I'd like to get into multifamily and get into bigger multifamily deals at some point like your company is doing. But seems like the biggest barrier to entry is that everything that seems to be available out there in the market is very expensive. That's high price per door, very low cap rate. So my question is just, what advice do you have for somebody who's looking to get into doing these deals and maybe find off-market deals, or how do you compete with the bigger players in the business who are getting fed most of the really good deals?
Yeah, no, those are great questions. I tell you the way that, because well, first of all, wherever you start, it's kind of the baseline for pricing, and it always seems like it's very expensive. $62,000 a door is very inexpensive now, but when we were going into it, believe me, we were thinking about the price. Like, hey, we really need to be getting this at 50,000, right? So that can be a little bit relative, and rates can be relative, and everything can be, so long as you can put it into a mathematical formula with some conservative assumptions. And if the numbers work, the numbers work. Because I ask people all the time, okay, so you don't invest in multifamily, you want to do something else with your money. Tell me what you're doing that's making you money right now. And people just kind of go, well, because essentially if your money is sitting still, you're losing money. You're losing purchasing power on that. You don't have the value of inflation, that the advantage of inflation when you're talking about real estate. And the stock market is up and down depending on when you need that. So from that perspective, I think it's more, essentially, no matter when it is, there's always an opportunity to invest somewhere. You just have to make sure that you have the right assumptions in place and that you're honest with investors. I mean, I tell you right now, it's very hard to get a lot of cash on cash for these deals. We used to get about 7% cash on cash, 8, 9, sometimes higher. It's gotten hard to do that. So we just tell investors, listen, this is a tough deal to do cash on cash on, but the return numbers are still phenomenal. I mean, essentially this cycle that we're in, what hasn't changed is that we still have a supply deficit of housing. And I don't care what the Fed does, essentially they're probably actually making it worse, because you have people that are builders that are not building, people that are deciding to stand still because of what's going on. And all that doing is exacerbating the problem of not enough supply. So over the long run, you're still going to be bumping up against, supply issues, which is completely different in 2008, right? 2008, it was an excess of supply. It was an excess in people getting essentially, zero down loans for properties and just crazy Wild Wild West kind of stuff. And they're expecting to buy a house and then essentially be able to flip it in 6 months after it was built and make $20,000, $30,000 on it, right? Or whatever. So I think it's a completely different place that we're in, and the Fed hasn't changed that. So I just need to be honest with investors and say, cash on this deal is going to be low, especially in the first couple of years as you're working through this process. And then it will pick up, one, and two, you're going to get your tax savings and you're going to get a significant return, probably more, because essentially there hasn't been cash on cash, but your cap rate, it will condense again at some point. I think it's just a matter of timing. And when we get into the next political cycle, nobody, I mean, the Fed's going to be feeling a lot of pressure to make sure that, you know, that it aligns well with the political cycle. I don't care if it's, they say they're apolitical. No politician wants to go into a cycle where essentially they're, you know, a recession or some sort of correction is happening. So I think sometime next year, the Fed's going to turn around and they're going to change things around again. So you just got to lock up some deals and understand that there's going to be some cash issues going forward, cash on cash issues. You still have to have money to pay the bills. Don't get me wrong. They still have to get to a certain number, but whether that translates to you being able to do distributions, high distributions to investors right away, I think that's where the debate is at, depending on the deal. Now, to your question about how do I get into these deals? What I recommend to people is don't focus on getting into a deal that you own, because I think that's where people get tripped up. They want their own deal. They want to find their deal. They want to eat their cake. They want to, you know, get in with a team. Get in with a team. You're going to end up working with a team anyway on multifamily. Figure out who it is that still needs a valuable partner to jump in with them. Because of course, if you're going to one of the big players, they probably have their team well locked up. You're not going to get in there. But there are probably some mid to smaller size operators in your area that are looking to build a partnership, looking to get into the game. Get in with them, because essentially what you're doing when you do that is you're buying into an existing network. So even if it's a smaller multifamily operator, they already have their preferred lenders, they have their attorneys, they have their insurance people they're already working with. And so when you're coming in, you can just ask them like, hey, even after that first deal, even if you come in as a passive investor, you can essentially buy into that network. So if you come in as an active investor, that's fine too. But essentially you have the ability to do better, to get into some deals sooner if you're willing to partner. I think that's what trips up a lot of people is they want to kind of do it all. And you're right. Why would a broker talk to you when they've got people that have already bought deals from them? So just figure out who they are. Don't pick their number one or number two, but figure out who their number 7 or 8 is on their list and try to work with them and tell them what you can bring to that team, whether it's cash, whether it's sweat equity or whatever.
Yeah, I think that's great advice, right? So sort of like partner with a perhaps bigger than you operator who would actually, who has their agent relationships in place, who's able to find a deal, and maybe you bring in the capital for them or other value, and kind of join their operator team. And I think that's a good way. I mean, if you can find a deal, then you can bring it to them. That's even easier. But I guess if you can make like a strong capital raising argument, that sounds like a good way to a more experienced sponsor who's got their deal finding capacity in order and all that. And I suppose another way, like Ismael, would you suggest entering in like smaller, either like secondary, tertiary markets or smaller properties, or that's just too risky a route to start in multifamily for some, like less experienced, like kind of people who want to build up their track record?
No, I think a lot of people are doing that. Even some of the bigger players are moving off of the primary, chasing yield, right? So they've gone to some of the smaller markets. But I think at some point going forward, you're probably going to have them chasing back over to the larger properties, which probably will leave some space in the smaller areas. And to your point about finding the deal, yes, that's an excellent way to get into a multifamily if you're able to underwrite a property and get it under contract. It's just hard to get under contract when you put your information in front of the broker and they don't know who you are. And they have to present it to the seller, and the seller has to decide whose offer they want. And I've actually been on the other side. We sold the property, was it March of this year, where the broker came to us, and there were 10 people on that list initially. And we didn't go with the number one group as far as from a pricing standpoint, because the broker wasn't comfortable with their ability to deliver. And they told us like, hey, this is the biggest number. This is the best offer, but we don't know them. And, we've kind of looked into them a little bit. They don't have a track record. okay, so we didn't go with them, even though it was the best numbers. So sometimes if you find a deal, have a partner in place that's already an operator, and you go to them and say, hey, I think this is a good deal. I underwrote it. Take a look at it. You probably have already done multiple of these kind of iterations where you think you have a deal, and then if you do underwriting and you present it to somebody who has done, has acquired properties before, because then once you've done that a couple of times, then you've already kind of built a little relationship with them. And then when you bring them something that works, then they're going to bring you into that deal, and you're going to partner with them. The LOI, the letter of intent that goes to that seller to the through the broker, may not have Scott Edward LLC, but it'll have whoever the main player is on that. But then you guys get to share in that when the deal gets under contract and you become part of that team. Obviously, there's some stuff you have to work through, but essentially you build those relationships, and then you hand off to that senior partner who's going to be able to kind of get the broker's attention. But by virtue of you finding it, it does guarantee you probably that you'll get into that deal.
Mm-hmm. Yeah, that's great advice. And any other questions you guys have? I guess let me ask. I have a question also with regards to asset, kind of commercial real estate asset classes. So do you, Ismael, have you looked into outside of multifamily, let's say within your portfolio, like in terms of be it self-storage or other asset classes, or is your focus predominantly multifamily? And specifically, I would focus on, we've had some triple net, kind of like triple net core real estate investors here. And I was recently looking at returns dispersion of core triple net versus multifamily. It's pretty stunning. It's like the returns dispersion in triple net it's like, it's something compared to the stock market, or it's just extremely narrow. So all the operators are within 2% range of returns. It's a very low risk operation, sort of like a bond. And I feel is that something that may interest you from the perspective of, okay, you're not offering this super sexy returns, but nevertheless you're offering extremely outsized favorable risk, that's better than the rest. And it's kind of an interesting thing. I've seen few people, it's the risk seems to be of the order of 10 times less or something like that. And I'm a fan of multifamily personally, and I've never invested in triple net or anything, but it does seem attractive to those very large deals. If you're looking at 200-300 unit multifamily deals versus the risk profile of triple net, it does start getting a little bit attractive at some point.
Yeah, no, that's good. There's a couple of things that I do outside of straight multifamily. Mm-hmm. The easiest is to explain, because it's very similar to where I came from. Is I'm a private lender, and I lend money to fix and flippers that are doing single family homes. Right. So, and I use my solo 401k. Some people use a self-directed IRA to do that, because I used to do that with just regular money. And you get a significant tax hit when you do it outside of those tax advantaged accounts. So that's one that I do, and it's easier to control because it's shorter term. You're talking about some properties, 4 or 5 months. You're essentially moving your money pretty quick, so you can kind of stay out of trouble doing it that way. And the other thing is we get first liens on these properties. So if somebody is not able to fulfill their requirements for that loan, we take over the property. And you just have to have a plan in place. I have a partner that does all of the work, and I essentially work with him. He runs that company. But we've never had to take over an asset, but we are prepared to do so. And we only lend at about 60% LTV. So 60-65% LTV is probably the max. So there's plenty there if something were to go wrong. But thank God to this point we haven't. We've been doing this for at least 5-6 years now. So it hasn't been bad. So that's one thing I do. On the other, as far as some other things outside of multifamily, I've been looking a little bit more into mixed use. It isn't necessarily not multifamily, but it's a combination of two, because I feel like, especially when you're looking at B-class assets, people want to, they want to live in places where they don't have to go too far for other amenities, whether it's, the coffee shop or whether it's, laundry or beauty service or whatever it is, right? And so if you can find the right location and have a bottom level, which is a commercial spaces, and then the top you have residential living, I think that's kind of what a lot of people are doing now. We have new developments going all the time, and it's kind of been the way that they do it. They essentially, mixed use at the bottom being the commercial, and it seems to work out well. So if we were to do new development, I think that's new development work. I think I'd want to do something like that in a place where clearly there's a need to have some of those commercial spaces. And then you can triple net those. And in fact, we're looking at an asset right now. It's going to be a 506B, so I can't go into the details, but it does have mixed use at the bottom. And it's actually not on the bottom because it's the garden kind of apartments, but at the front of the property, there's mixed use. And then if you just go behind it, you have your actual living spaces. So it does provide for some of that. So I think that's kind of where I would want to go with newer development, and B+ assets, B assets, and certainly A- is some sort of mixed use kind of engagement.
Right. And those seem particularly interesting for development. I was looking at some kind of like strip mall development projects. They do get like pretty interesting like returns profile and potential. And so having it mixed with multifamily, like for the right amount of risk and so forth, sounds like a great way to go. So, Ray, so what is the best way for people to reach to you? I know you've provided some great answers to us here today. And also, if there's anything else you want to share with us, like from your experience, or that particularly you want to make sure to get out there as far as information to our audience, do let us know as well. Mm-hmm.
Yeah, I think as far as messages go, I just want to encourage people to step forward and not feel like this is not the right time to get into the deals. I think you just have to understand the variables, understand the numbers, and make sure you have the right assumptions in place and that the deals make sense. Because I guarantee you, the people that are doing deals now are going to be the ones that are going to build real net worth moving forward, because properties are trading for less. We've got several that I've seen that had $1.5 million reductions because cap rates are starting to go up a little bit. And frankly, the lending is because of the Fed and what's going on with the rates, the numbers have gone up. But it's very easy to explain that to a seller, say, hey, the numbers just don't make sense. So, and that everyone's doing that. So long as you get into the right loan product, and I've seen some mixed, some loan products that are interesting where it's a bridge, but it's got a set amount of fixed rate on the front end of it, and those are good because you're not paying. One of the things that you pay when you do bridge loans is you pay for a rate cap, and rate caps right now, all that means is like, hey, you're going to pay a certain amount. It's a floating rate and it can only go up by X amount because that's your cap. You're buying essentially. So that interest rate can't go up higher than a certain amount. But that rate cap, to have a 2% rate cap. So let's just say right now it's 5%, and you buy a rate cap of 2%. The rate can't go any higher than 7%. If it does, you get reimbursement from that insurance, that rate cap broker, and they give you money back for anything that's gone above that, right? But the problem is it's so costly right now. You're talking about $700,000 and sometimes higher to get that rate cap. So it's just a little bit difficult to do that. But then if you do a fixed rate at 6% right now, you have the opposite. When you try to get out of that deal, you have made your yield payment that you have to make because you're holding on to the loan too long. But there's some products out there that kind of give you the best of both worlds. You don't have to have the rate cap. You sacrifice a little bit on the actual rate itself, but you don't have the rate cap issue. And then you don't have the yield on the back end. That's a fantastic way to get into a deal, hold it for a couple of years. When that rate starts dropping again, refinance and be in a place with a property that you bought for a lot lower than you normally could because the prices are a little bit low now. So don't give up on finding the deal. Don't freeze up and because you're going to regret it. I mean, I think that's the biggest message. As far as where people can get a hold of me and talk some more, my website's got all my social media on there. It's mirealestate.us, mirealestate.us. And you can get on my calendar right there. I mean, essentially, we can have a chat about anything, whether you want to invest or not. I mean, sometimes I get people that are selling me stuff through my calendar because I make it so accessible that people are like, hey, I signed up and I want to sell you something. So I kind of I get rid of those pretty quick. But if you legitimately have questions and you just want to have a discussion, I love what I do. I love having these kind of discussions, and there's no cost to you to get on a call with me for 30 minutes or so. So I encourage anybody to do that wants to.
Okay, that was awesome. Thanks so much, Ray. It's a great presentation, great value to our audience, and yeah, appreciate being here today. Thanks to everyone who joined us, who joined here, and so have a good night. Yeah, thank you.
Thank you, Stefan. It's my pleasure.
Thank you.